We're looking at the sort of mixed picture. You're seeing McDonald's on one end of the spectrum and Google on one end, and then you have Amazon. How do you make sense of this?
So we're about 52, 53% of the way through earnings seasons. We've front-end loaded a lot of the sectors already, Andrew, that have good earnings. So financials, tech, industrials have all been early in the season. What comes later in the season?
Dogs.
Well, later in the season comes healthcare, energy, staples, which all probably have the
Apple
lowest.
coming up, and you have some other biggies
You do,
this week.
part of the tech side, but we're getting to the backside of the earnings season. So I think the percentage of beats on both earnings and sales probably slows in the back half, brings us back to somewhere around a 2.5% earnings growth for the quarter.
Hey, Mike, we're going to have, I assume today's going to be a light day. It's a Friday. I don't know what time you think people are going to, head to Long Island.
Yeah. It'll be light, but I think significant because we did get this GDP number that I think we have to kind of filter through people's expectations, not really for what the Fed is going to do in 5 days, because it's probably too close to change that story. But I think investors are going to have to assess what this means for what this tightening represents, because it doesn't really seem to represent any kind of effort to stimulate the consumer U.S. economy, which looks great when you have Starbucks and McDonald's comping those ways well above 5% in this economy. Obviously, that's not the mission. It's looking a lot more like a technical adjustment to get short-term U.S. rates down toward the global standard or the global norm, and especially get them below where the 10-year yields are. So if that's the case, have we already priced it in? Because the stock market is up 20% since the Fed last tightened in December. That's way different from almost every tightening, from almost every beginning of a rate cutting cycle we've ever seen before.
Hey, Darrell, I wanted to ask you about this. Did you see this story in the Wall Street Journal this morning? I want to show you this. Investors buy bonds even as shares rally. What's going on here?
It's interesting. I'm glad you brought that up, Andrew, because I was looking at flow data for the first half of the year. $150 billion of net outflows of equities. That's the largest outflow of equities we've seen in 4 calendar years through July.
Right.
And yet markets are screaming higher. Inflows into bonds, $455 billion. For the entire 10-year cycle, we've put $1.7 trillion. So we've had 25% of all the net inflows into fixed income just in the first 7 months of this year that we've had for the entire cycle.
But if these people were your clients, would you be telling them that they're right or they're wrong?
We actually think the bond market looks rich to us right now, right, with where rates are. Unless you believe the 10-year is going to zero, unless you believe we think the Fed pricing in 100 basis points of rate cuts.
But what do you think these people believe then?
I think a lot of people have been still positioned for the slower growth and recession problems, right? And we clearly saw, as Mike pointed out with GDP this morning, at 2.1% GDP on the back of 3.1%, this whole fear in the first half of the year on recession worries just is unfounded.
But we're going to have even tougher. Don't you think we're going to have even tougher comps next year?
Tougher comps on earnings.
Yeah.
The tough comps on earnings are this year.
You think they're done?
Coming off a 20+% earnings growth last year, that's why you're seeing 2-3% earnings growth. I think the fourth quarter numbers still have to come down. 10% is unrealistic earnings growth for the fourth quarter. And next year, sitting at 11% earnings growth on the consensus is probably still too high. So that has to come down. Markets have to adjust expectations.
But that's the point. If everything adjusts.
Yeah, the second half of the year to us looks like a grind, right? It's kind of
a grind higher or a grind lower?
No, probably a couple percent higher. We think we front-end loaded a lot of the gains in the first half of the year. And the second half of the year, you get some episodic volatility, which has been non-existent in the first half, and maybe 2-3% higher from here.
Do you want to be in cash right now? I mean, do you think there's going to be a low point where people are actually going to be able to pick something up on the cheap?
Well, in our portfolios, we're actually overweight cash right now because we think you're going to get some pullback here. So we would not be aggressively buying equities at today's levels.